Hello, fellow Rebel Capitals. Hope you're well. So we've got Nvidia. Earnings are out. Everybody has been talking about how important this is for the overall stock market. We're going to be getting into the details in just a moment. We are also going to be talking about how housing demand is plummeting, even though rates are coming down. And then finally, we're going to talk about how now, all of a sudden, CNBC goes from jizz in your pants type of bull. What was the acronym we were using for that, or the abbreviation? JIMP. That's right. JIMP. Jizz in my pants. Oh, bye. Just anything. Bad news is good news. Good news is good news. And now all of a sudden it's, this is maybe a recession signal we should be watching. Now, does that mean because they're quote unquote experts have turned bearish, or is it more of a political thing? We're going to get into that in just a moment. But let's go to the Nvidia earnings here. And it just came out a couple minutes ago. So I'm looking at this pretty much for the first time as well. Let's click on this. Breaking. Nvidia sales grow 78% on AI demand. Company gives strong guidance. That seems pretty darn good to me. But of course, it's all about the expectations of the market. A lot of these stocks, these Mag 7 stocks, are priced to perfection. So it's not just they grew sales by 78%. It's if market was expecting 80%, then that's actually a miss. But I think that should be perceived as good news, although, this is not my area of expertise. The macro stuff and the freedom and liberty stuff and the monetary system, that's more what I like to get into the weeds about. As far as the actual balance sheets of these companies and what drives the stock price, I leave that up to people like Lynn Alden and Chris McIntosh and other pros in Rebel Capital's Pro. Do a little plug there. But it looks like just the market is perceiving this as to be not as good as they hoped. And I'm saying that just because it looks like it's down in aftermarket 1.25%. So let's keep reading here. Nvidia reported fourth quarter earnings on Wednesday after the bell that beat Wall Street expectations, and the company provided strong guidance. Shares were flat in extended trading. Now they're down. Here's how the company did. And again, you see, that's the problem with buying these things at such nosebleed levels, because they're not just priced to perfection. They're priced to even exceed perfection or exceed the lofty expectations that have already been set. So you have to really just blow away the market in order for the share price to continue to go up. And if you just exceed expectations by an amount that doesn't match up with the share price, you're going to hit that air pocket and potentially go down. But we're going to have to pay a lot of attention to see how the share price responds tomorrow. But let's get back to this article. So specifics: revenue 39 billion on a 38 billion estimate. So good there, but maybe not good enough. Earnings per share 89 cents versus 84 was expected. Nvidia said that about 43 billion in first quarter revenues, plus or minus 2% versus 41.78. Net income during the quarter rose to 22.09 billion. Revenue continued to surge. Nvidia's revenue in the quarter, okay, we got that. However, Nvidia's growth is slowing as the company becomes larger. During the fourth quarter of fiscal 2024, Nvidia's sales more than tripled. And believe it or not, again, that's slowing growth. It's just, these things are at a growth trajectory like this, and they're priced to increase that growth trajectory to this parabolic straight up. So even if they go from here to here, I mean, it's still great, but that means the share price goes down. And again, this is why I preach over and over and over again and pound the table on these videos and the whiteboard videos that it's not about just what's the price going to do, because at the end of the day, that's almost impossible to know. The only thing that you can know is share price expensive or share price cheap. That's the only knowable. So you've got to start by asking that question, as opposed to start by asking the question, is the price going to go up and down? Go up or down, excuse me. Getting back to the article. Sales are in the company's data center business, which now comprises 91% of company's total sales. That's what I call all the eggs in one basket. And we'll have to see if the DeepSeek impacts that, or just that type of model, because it might not be the straw that breaks the camel's back, but you could have an American company, as an example, that looks at what they did and say, that's interesting. And then they go ahead and improve on it. And then another company improves on that. You keep having this kind of chain reaction to where it does put a dent into Nvidia's results. And it's so fragile there because of what we are talking about. Nvidia's gaming business, which includes graphics, 3D games reported. Okay, so that's almost irrelevant, almost a rounding error. It's all about those data. It's all about the data center business, that's for sure. So let's go ahead and refresh. Okay, so now it's not down as much. We'll have to see where it opens tomorrow. But so far, it seems like it's not amazing. It's not blowout, but it's pretty good, and therefore not going to really move the share price too much. And why is that important? Because Nvidia is such a huge, huge component of not just the Mag 7, but of course the S&P 500. And the S&P 500 is such a huge, huge component of what drives aggregate demand in the economy. Therefore, said another way, it's such a huge component of the US economy in general. If we see Nvidia just absolutely crash, we see the Mag 7 crash, we see the stock market crash, and then eventually that leads to a potential crash, at the very least an economic contraction in the real economy, because that impacts asset prices, impact purchasing power to such a massive degree. And that's not the way it should be. Obviously, that it should be based on productivity. It should be based on how many goods and services the private sector is producing. But unfortunately, now we've just got this financialized economy. It's the inverse of what it should be. Let's go over to see what's going on pre-market. Now, I'm assuming, so Dow futures down 265 points. Now, I think what's important to point out here is, since Walmart came out last week with the negative projections for 2025, we have seen the bad news go to bad news. And I think this is what I'm paying most attention to. And you would expect, if you see like 3 or 4 down days in the Dow, the S&P, that you would have a pretty substantial pullback, a dead cat bounce, short selling, whatever you want to attribute the reason to. But we're not seeing that to a large degree. So this is the futures for tomorrow. But let's look at how markets closed today. Dow down again, 188 points. Now, S&P basically flat, and NASDAQ basically flat. But let's look at a chart. And just look at this. I mean, It's just down, down, down. And you get this little teeny weeny bump right here. But man, even I think the bears, when you get this big of a decline, would expect a bit of uh, the chart would look kind of, instead of like whoop, like that, would look more like from here. You guys can see my pointer, and then up to maybe here, and then kind of chop, and then come down again to where you're just getting these lower highs and lower lows. But right now you're not even getting, you're barely getting a lower high. You're not even getting that. You're not even getting the blip blip. So I'm not saying that this is the beginning of a market crash or a bear market. Who knows? This is probably the buying opportunity, the buy the dip, buy the dip, buy the dip. But it just seems like this time could be different than all the buy the dips that we've had over the last, let's say, 6 months. And to me, this is, along with the dollar and the 10-year, is probably the most important thing to try to think through and analyze. It's when does this narrative change, or does it? Now let's go over and look and see what is happening today with bonds. And this goes back to what I'm saying with maybe we're risk off. I mean, the 10-year treasury, let's look at a chart of that. We're down right now, if you guys can't see this, 4.25%. So we just re-inverted. If you look at the Fed funds, and I believe the 3-month as well, and it didn't stop. I mean, it's continuing to go lower, and it's just crazy to think just January 13th. So call it 6 weeks ago, we were at 4.8. So we're down 55 basis points in just a few weeks. And this, mind you, is with the CPI going from 2.4 to 3%. One of these two indicators is wrong. It's either the long end of the curve or it's the CPI. I'll let you be the judge. But for me, I would place my money on the long end of the curve and that CPI starting to roll over and come down. And I realize it understates it. We're just using that as a proxy for the direction of consumer price increases. And if we start to see the economy softening even further, aggregate demand goes down, potentially recession, that is always, every single time, not necessarily deflationary, but it's always disinflationary from wherever you start. Now, also, I would not be a bit surprised if we went from 4.25 straight back up to 4.4. And then you kind of chop around noise, and then it continues to go down if we see the data continue to get softer. Why? Because nothing ever, ever, ever goes up or down in a straight line. Let's look at the huge move that we saw in Bitcoin again today, down another 5.3%. So you're looking at right around 83.5. And what was really amazing today is I think MicroStrategy was actually up slightly. So I'll let you guys figure out what's happening there. But the bottom line is we got a lot of volatility, and a lot of volatility to the downside. And look at this also too. I don't think this is a trend, but it is interesting that Bitcoin is down even more than Doge or XRP. But still, Solana, which is definitely taking it on the chin, is down even more than Bitcoin. So what this tells me is it's just further indication that the market is potentially perceiving things differently. And it's just were so risk on, risk on, risk on, mania, hysteria, fart coin, Trump coin, Melania coin, Doge, Elon Musk, all of these things. And I would admit a lot of them are positive, but people just got up into this hysteria where it's just anything, buy, 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 risk on, we're going to the moon, baby, FOMO and YOLO and all these other things. And then they kind of realize that, wait a minute, maybe the economy's not doing so well. And even if we approve of what Trump's doing, maybe that's going to take a long time to where we actually see the dividends pay off in the real economy. This is just speculating. I'm trying to put the pieces of the puzzle together. At the end of the day, it's up to you to decide how you think this is going to play out and what this actually means. Let's go over the housing data, because we have to look at the good, we have to look at the bad, everything in between to do a proper analysis. And you get the bullish argument all the time with the mainstream media, although that's slightly changing. Chris and I talked about this yesterday. But there is another another crack in the dam that we have to pay attention to. And that's the housing market. Not really seeing prices collapse, but you're seeing demand go down. And what's really odd is we have seen mortgage rates, as you would expect, go down significantly with the 10-year Treasury yield, which you would assume would drive demand even higher. We're seeing the exact opposite. So let's go over to this article, another article from CNBC, and try to go over what's happening. Now, it's just over the last couple of weeks. So the very short term, it doesn't mean that this is a trend that's going to continue throughout the rest of the year, but it's something that we have to be cognizant of. Right here. And actually, I'm curious. Let's look at a chart of the 30-year mortgage rate, because I haven't looked at that in a while, and obviously that pertains to what we're going to talk about. So Freddie Mac. I know that, like, Nerd Wallet. Doesn't Nerd Wallet like have I want more real-time stuff. Nerd Wallet, there we go. Current mortgage interest rates. And usually they've got a pretty good chart. And of course, on this article, there we go. There we go. So this is the 30-year. And just look at this. From February, the 1st of February, we were right around 6.8 and 6.81. And currently we are down to 6.59. So that should encourage demand. Let's look at what's actually happening, though. When we go to CNBC, here's the title: Mortgage rates dropped to lowest since mid-December. Not that long ago. But demand still falls short. Key talking points: average contract interest rate for 30-year fixed rate with conforming loan balances decreased to 6.88% from 6.93. So we saw a little bit more of an increase on NerdWallet. They're probably combining all 30-year fixed, where here they're focusing on a specific portion. Applications to refi a home loan, which had been surging through much of January, fell 4% for the week. Application for mortgage to purchase a home were flat for the week and 3% higher than the same week 1 year ago. So really where we're seeing the decline is on these refis, which that makes a lot of sense, because if you are hell-bent on buying a house for whatever reason, you're probably going to still move forward with that. You probably weren't going to buy a house if you lost your job, or you probably weren't going to buy a house in the first place if you were kind of leery about whether or not you would lose your income in 2025. But it's a whole different equation when you're looking at a cash out refi or a refi in general because you've got fees. It's just you already have the house. It seems like that would be the first shoe to drop. So the details here, mortgage rates dropped. Okay, we got that. The total mortgage application volume fell 1.2% from the previous week. Now, wait a minute here. I thought that it said that applications for a mortgage to purchase a home were flat for the week and 3% higher than the same week 1 year ago. Total mortgage applications fell 1.2%. What am I missing? The only thing, oh, total mortgage applicant. Maybe they're including the refis in there. I'm not sure where the discrepancy is, but the bottom line is it's overall it's going the opposite direction of what you would think if you just looked at the interest rates themselves. Another thing that's really, I think, even more interesting now that I'm thinking this through out loud is why are the rates not going down at the same level as the 10-year treasury? So let's think this one through. Since the beginning of February, based on NerdWallet here, we've gone from 6.88 down to 6.59. So call it what, 30 basis points, 28 basis points. But now let's look at a chart of the 10-year treasury just in February. And drum roll, please. We can look at the start of February. Okay. So I thought they're actually down more than that since the beginning of February. There's not too much of a delta there. So, okay, that's probably a nothing burger. Oh, that's right. We're at CNBC. Okay, let's get back to this article. Treasury yields move lower on softer consumer spending data as consumers are feeling somewhat less upbeat about the economy and the job market. This pushed mortgage rates lower, with the 30-year fixed rate decreasing to 6.88%, the lowest rate since December. Applications, we talked about that. Overall refinance applications activity remained fairly weak. We're talking about mortgage rates dropping. Long story short, this is a quote, bonds are in fashion at the moment. Okay, thanks for telling me something. Thank you for restating the obvious. The broadest and most common explanation has to do with expectations for downshift of global economic growth in response to domestic. Oh, they always, you know, they always have to blame interest rates are coming down. Oh, well, obviously, growth and inflation, more so growth, expectations are coming down. It has to be because of the tariffs and blah, blah, blah. Look, I'm not a big fan of tariffs as far as an economic policy, but you can't blame them. They haven't even implemented the tariffs yet. You can't really blame them entirely for the 10-year treasury yield going from 4.8 down to 4.25. I mean, come on. It's almost getting to the point where that's like volatile food and energy. You guys, you watch my videos, you know how they have to include that on everything, excluding volatile food and energy whenever they're talking about inflation. And it's like that's the tariffs and the cost cutting efforts. That's the new kind of boogeyman for anything that happens bad in the economy. They have to insert that in there. I'm curious to go back to Nvidia to see what they're doing in aftermarket. Remember, it was about okay, so now it's up. Wow. It's up pretty good. 2.28%. So I guess the market is digesting this and they're saying, okay, great, giving them the benefit of the doubt and share price increasing. But again, we're really going to, after hours, you can't tell too much. You're going to have to see how it plays out tomorrow. We'll go over that on tomorrow's video. All right, now let's go over to the mainstream media completely doing a 180. And it's just so blatantly obvious. Now, I think this might be kind of politically based, but I want to go over it just to show their hypocrisy. And then also to add further details to the whole narrative shift thesis. Salesforce, by the way, misses revenue issues, disappointing guidance, good. I do not like this guy at all. I mean, look, the best picture of him is when he's standing in front of a billboard or the background for the World Economic Forum. That pretty much tells you everything you need to know. He is basically an acolyte of Klaus. This guy, Benioff is his name. He always wears all black as well. It's like, dude, we already know that you're the devil. Like you don't need to. I won't go on and on about that, but I really don't like this guy. And if you've read what he's said, it's for good reason. The guy is just he's so part of the Malthusian cult, and he tries to spew that nonsense everywhere. And if you're part of the Malthusian cult, I don't like what you're all about, and I'm going to call you out on that one. Here we go. So you guys know from watching my videos, when the yield curve inverted, let's just say 2 years ago, you didn't hear a peep about it on CNBC. Barely even a mention. Yield curve? Oh, no. Completely disregard that. In fact, I remember Jim Cramer, this was maybe 6 months ago, talking about how it's totally irrelevant, that anyone that focuses on the yield curve is just spreading FOMO and FUD, or not FOMO, but they're spreading FUD, and they're just fear-mongering and all of these things, and that we should just don't pay any attention to it. It's all about issuance or something like that. What you have to do is just strictly focus on corporate earnings. Corporate earnings. And, therefore, I think CNBC was just kind of sweeping this one under the rug. The only people that we're really talking about were media sources like Zero Edge and whatnot. And now, all of a sudden, that we have the yield curve reinvert, listen to what they're saying. The Federal Reserve's favorite recession indicator is flashing a danger sign again. Okay, well, why didn't you tell us it was flashing a danger sign when it first inverted? Why are you now choosing just to comment on it when it's the second go around? I think we know the answer there. And the answer is it's just total political. So if Biden is in office, or the Democrats, the people they like, then if something is bearish about the economy, well, we just got to, let's not talk about that. Let's just focus on the positive. And then when Trump's in office, it's like, oh, hey, look at every single thing that's negative. We can go ahead and point to that and do a complete 180. And then we can blame it on, you guys know, the tariffs and the cost cutting. Oh my gosh, we're cutting government. Are you crazy? Well, that's obviously going to lead to a recession. We can't have that. And it's just, it kind of just makes you sick to the stomach. But it's exactly what you'd expect from the mainstream media. Exactly what you would expect. So I know I said I was kind of on the fence as to whether this was political or whether they're just changing their narrative And I think I've made up my mind. It's definitely political. It's definitely political. At least that's my base case. I'll let you guys be the judge of what you think. But let's get into the key talking points and to see how they're kind of framing this. My guess is they're going to just blame everything on Trump. The 10-year Treasury yield passed below the 3-month note in trading Wednesday. In market lingo, this is known as an inverted yield curve, and it's had a sterling prediction record. Let's see, just the total opposite of what they were saying before, and that's if they even mentioned it. While there's no certainty growth will turn negative this time around, investors worry that expected growth from an ambitious agenda, here we go, under President Donald Trump may not happen. Yield curve inversions have had a strong but not perfect forecasting history. In fact, the previous inversion happened October 2022, and there still has been no recession. That said, they always revise these numbers, and just like with 2008, we could wait till December of 2025. Referring to the fact that the NBER, they didn't announce a recession until December of 2008 when we'd been in a recession for the whole year. So you can't really take the GDP numbers and the unemployment numbers at face value as they come out in real time, because it's always one of these things that they adjust them way, way, way down when it's just totally obvious to everyone that we are absolutely in an economic contraction. The ominous measure the Federal Reserve considers a near surefire recession. And actually, this is not their number one indicator of recession. Their number one indicator is the short-term, what was it? The near-term forward spread. That's what it was. The near-term forward spread, which I don't think is exactly the 3-month and the 10-year. I haven't done a video on that in a long time, so I'm having to pull that up from memory from probably 9 months ago, 6 months ago. But it's more so the near-term forward spread, which again, I think is slightly different than just looking at the 3-month or the 10-year, but that's a pretty good proxy. I'll give them some leeway there. 10-year Treasury yield passed below 3-month note on Wednesday. We know that. They said this has had a good sterling prediction record over a 12 to 18-month time frame for downturns going back decades. In fact, New York Fed considers it such a reliable indicator that it offers monthly updates on the relationship along with percentage odds on a recession occurring over the next 12 months. Okay. At the end of January, when the 10-year yield was about 0.31 point, what? 31 basis points, let's say, clear of the 3-month, the probability was just 23%. However, that is almost certain to change the next time they give us a number. Okay, yeah, we get that. I think what's more important is we go over to the CME and we find out what they are saying in real time, not necessarily for the inversion or the steepener, but more so just Fed funds specifically. And we haven't gone down that much. So this is really kind of crazy, is the market is not pricing in as much of a probability that the Fed cuts rates as you would expect. Now, to be clear, I am not saying that the data that we've seen recently would take the probability to like a 60 or 70%. No. But I would have thought that the 10-year going down to the degree to which it has, and then the curve reinverting, would take the probability from, let's say, 97%, at least down to like 85. But it's only gone from 97 over the last week down to 95.5. So we're going to have to watch this one very, very closely. one more check with futures. And okay, NASDAQ up about 118, Dow down about 184. And to get our risk off proxy, Bitcoin right around the same, call it 85,000. Okay, guys, enjoy the rest of your afternoon. As always, make sure you are standing up for freedom, liberty, free market, capitalism. We'll see you in the next video.